Based on the marketable borrowing estimates published on July 31st, Treasury, this is crazy, Treasury currently expects privately held net borrowing of $1.007 trillion in this quarter, with an assumed end of September cash balance of $650. And then they said we expect another $852 billion of borrowing next quarter. That means Treasury is going to try and issue and sell $2 trillion worth of Treasury bonds in the next 2 quarters. That's $2 trillion of new borrowing by the federal government to pay our bills. At the start of the year, they were estimating $1.6 trillion for the year, which was an insane number. Now we're talking about $2 trillion in just 2 quarters.
A few days ago, the United States Department of the Treasury released its current estimates for privately held marketable borrowing in the third quarter of 2023 and the fourth quarter. During the third quarter, the Treasury Borrowing Advisory Committee projects a borrowing of $1.007 trillion in privately held net marketable debt, assuming a cash balance of $650 billion at the end of September. This updated estimate is $274 billion higher than the figure announced less than 3 months prior. For the fourth quarter, the Treasury anticipates borrowing $852 billion in privately held net marketable debt, with a projected cash balance of $750 billion at the end of December. In the recent episode of the All In podcast, prominent figures like venture capitalist Chamath Palihapitiya, entrepreneur and angel investor David Friedberg, and David Sachs, co-founder and general partner at Craft Ventures, delved into the topic of the federal government's escalating debt and its potential ramifications. Friedberg particularly highlighted warning signs for the U.S. economy, including the risk of losing the dollar's global reserve currency status due to unchecked fiscal spending. He cited Fitch, a major credit rating agency, which recently downgraded the U.S. government's credit rating. Friedberg emphasized that investor confidence in the U.S. government's ability to manage its massive debt obligations is waning. However, opinions varied among the podcast participants. Chamath disagreed with Friedberg's dire outlook, suggesting that while the U.S. economy is facing challenges, other economies are in even more precarious positions. Sachs took a middle ground stance, acknowledging signs of trouble while indicating that a complete collapse might not be imminent for the U.S. economy.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
This is a pretty striking chart, and I think I showed this before. This is federal government interest payments that are being made. We're now up to, $1 trillion. The chart, as you can see, a year has spiked. And by the way, that number is spiking further, and we'll talk about this in 1 second, as a result of rising interest rates and increased fiscal spending. So this is now becoming a pretty sizable part of our budget. And as of now, paying the interest on our debt is a larger capital outlay for the federal government than defense spending. The second chart shows what happened in the last week, which is that 30-year treasuries have been sold off. And as that's happened, treasury yields have climbed. So there's been about a 10% decline in pricing and a concurrent nearly 10% increase. And Bill Ackman, basically said today that he's shorting 30-year treasuries. He thinks we're going to go to 5.5% long-term rates. Currently, the 30-year treasury is sitting at 4.3. And remember, I told you guys this after this thing I went to a few weeks ago, that there were 2 prominent economists who shared that they think we're going to be facing long-term rates in the 5 to 7% range, very long-term rates for a very long period of time, that it is a new fiscal regime. And then if you pull up the last link I sent, Nick, this is a report made by the Treasury Borrowing Advisory Committee of the Treasury Department. And I just want to read a couple of quotes from this report. This just came out today, and it was published. It was sent over to the Secretary of the Treasury yesterday. And it said, since the advisory committee convened in May, 2-year Treasury yields are about 100 basis points higher, while 10-year Treasuries have increased by about 40 basis points. The bank holdings of non-mortgage-backed government securities, mainly Treasuries, have actually declined by $146 billion so far this year. So that means banks are selling off their Treasuries. The committee goes on to say, at the same time, Treasury investors have noted the Treasury supply will need to increase to address the rise in public deficits as tax revenues have come in weaker and government spending has increased. Rates are climbing. As a result, we need to borrow more. And this is a perfect manifestation of the debt spiral problem that we've talked about multiple times. Our fiscal spending outlay and the rising interest rates combine to create an insurmountable debt spiral that is now manifesting in the fact that we need to sell $2 trillion of treasuries. And here's the crazy statistic that they said. In reviewing recent demand for U.S. treasuries in auctions, the committee noted that an increasing percentage of supply is being absorbed by investment funds, while foreign participation has remained range-bound. That means as we're trying to sell more treasuries, foreign governments are buying fewer of them, which means that the US currency as a reserve is no longer the place that everyone wants to plow their money as much as it used to be. It is in decline. Now, the other thing I want to share, which I think is absolutely critical, is how do we address this gap? Well, the one way is these entitlement programs. And so several Republican presidential candidates, Nikki Haley, Ron DeSantis, and Mike Pence, have all publicly stated on the campaign trail that they're promoting programs to cut Social Security benefits for people that are 30 and 40 years old. And here's the response to that. A poll was done. And on that poll, 82% of voters oppose the push to cut Social Security for Americans under 50. 82%. So where is this going to take us? This is what is so scary to me, J-Cal. I'm not an American declinist. I believe in the American system. It benefited me and my family. But I do worry that we find ourselves in a whirlpool that is very hard to get out of because the populace says we don't want to make the cuts that are necessary in order for us to save ourselves. That's what's so scary to me.
According to Friedberg's assessment, the US dollar may retain its world reserve currency status for the foreseeable future. Nevertheless, its purchasing power is expected to continue eroding, potentially reaching a point where the dollar holds no value. In contrast, Sachs predicts that the initial indication of trouble will manifest in the stock market. Given the federal government's urgency in selling multi-trillion-dollar bonds within a tight timeframe of fewer than 200 days, Sachs explains that the Treasury will need to elevate bond yields to attract both domestic and international investors. However, this action is likely to reduce the flow of funds into the stock market, leading to a deceleration in growth and overall economic activities. On a more positive note, Chamath envisions a brighter future for the U.S. economy, particularly in comparison to the challenges being faced by other major economies such as Japan. For further insights, here are additional segments from the interview.
Let me just state what I think about the downgrade. It's irrelevant. The S&P did it 13 years ago. Fitch is a marginal credit rating agency. They're at a minimum 13 years late. At a maximum, they're just anxiety-ridden, like other people are, who are always screaming that the sky's falling. So that's my first point. The second point, and the more important one, is that none of you who are always freaking out about this understand this conversation about relativism. All of these conversations are relative. You deal with them in absolutes. On a relative basis, Japan's debt to GDP is 270% and growing. On a relative basis, our debt to GDP is half of that. We are the most important economic force in the world. It is going to continue to be the most economic force in the world. And all I see actually on every single monetary basis is every other country struggling more than we are. So my question to all of the Chicken Littles is, what do you do if you're a central government where you have to have foreign reserves? Do you all of a sudden double down on the euro? Do you double down in the yuan, which is basically a proxy for doubling down in the US dollar? What are you supposed to do? And I never get a good answer because on a relative basis, the US will still continue to do well. I think that debt to GDP is a red herring for a lot of people. And I think that the way that people run their personal lives, which should take income to debt into consideration, I don't think applies as much to governments. And I think these things are going to march forward as a group. There's not going to be a single G8 country that all of a sudden moves away and starts printing surpluses. It happened almost as an accident, an aberration during the Clinton administration. It'll never happen again. And I think that we shouldn't worry so much because I just don't see an alternative. So give me, instead of telling me how bad this is because you think about your own life and how it would be bad if you had debt to GDP of 100, I get it. As a country, give me the alternative country. But just start with that. Can you answer that question? What is the alternative country?
Well, let me paint a scenario that's not as dire as a collapse of the US dollar as the world's reserve currency. Let me paint like a non-catastrophic scenario or non-apocalyptic scenario, which is what you saw in this Fitch ratings downgrade is that the bond market did move at the margins. There was a sell-off in the 10-year. And as a result, the 10-year bond yield moved up to 4.2%. So it wasn't a case of everybody shedding all of their U.S. treasuries. It's just that there were market actors at the margins who adjusted their portfolios. Okay, now, Friedberg is saying that the Treasury is going to have to do another $2 trillion bond offering. And we have $1 trillion plus deficits as far as the eye can see. And we've got entitlement liabilities on the horizon and then a political unwillingness to do anything about it. So the deficits are only going to get bigger and bigger. Now, what does that do? It's supply and demand. When the US Treasury needs to keep issuing more and more bonds, at some point, the demand for those things gets incrementally saturated, and they have to offer a higher yield. So what happens? Well, the bond rates go up, and so the 10-year goes up, like Freeberg was saying, from 4.2 to somewhere in the 5 to 7% range. And that doesn't mean the US dollar is not the world's reserve currency. It just means that it gets incrementally harder and more expensive to keep financing our debt. Now, what is the result of that? Well, if I, as an investor, could theoretically get 7% from the US Treasury as the risk-free rate, why would I want to take equity risk and put it in the stock market, which historically has yielded somewhere in the 5 to 7% range? So if I can get my 5 to 7% from a risk-free US government bond, of course I'm going to do that. So the discount rate on equities will go up. That means that the stock market on a relative basis will go down.
Risk capital will go down. There will be less risk capital
will go down, and there'll be way less risk capital available for things like venture capital and private equity, just risk-taking of all kinds. And so the economy will just grow slower. It's not like there'll be a collapse. It'll just be this huge albatross around the neck of the private sector. And this is called crowding out.
In the current month, the Treasury is slated to auction $270 billion in notes and bonds, marking a $24 billion increase from the sales volume in July. This week, the auction size for notes and bonds will be elevated to $103 billion, followed by an additional sale of $167 billion later in the month. The uptick in issuance will be more pronounced in October, with a $35 billion increase, bringing the issuance of notes and bonds to $281 billion. The Treasury Borrowing Advisory Committee forecasts that by August 2024, the Treasury will likely augment its monthly issuance of primary notes and bonds by nearly 60%, reaching a total of $354 billion. The committee emphasizes that these quarterly estimates could be further augmented in subsequent quarters to accommodate reduced government revenue and heightened spending. What are your insights regarding the imminent influx of notes and bonds into the market? How do you anticipate this might influence cryptocurrency prices over the forthcoming months? Feel free to share your thoughts on both the video and the featured discussion in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.